Hey, good morning, everyone. Marty Mazur here, Wednesday, the 25th of January, 2023, with your midweek market snapshot. Really not a whole lot to report. Things are pretty much playing out, relative to resistance levels and things that we pointed to of late. So I'll just jump in today, and we're just going to keep it really tight and look at the daily and the hourly chart of the S&P 500. So on your screen there is the daily, of course, and we've been pointing to, forever now, it seems, this bear market trend line as really, really stiff resistance, right? One thing I want to point out that the tests of this downtrend line are becoming quite a bit more frequent, obviously, than we've seen so far. So despite our overall bearish narrative and the fact that we believe that the market will probably pierce what was initially our bottom, bear market target. Again, that was contingent upon staying out of what we view as recessionary conditions, which we are in now in terms of what odds point to going forward. And so it was 3,500 if we didn't see recession coming. It was, we think probably more like 3,200 amid a recession, and so that would now be our ultimate downside target for this particular bear market. Of course, it doesn't have to play out that way. We're open to all possibilities, but that's what we see as where probabilities presently point. Again, though, market really seems to want to continue to beat up against this resistance. So the more frequently and the more you beat up against something, the better the odds are that it will ultimately break. So remember, we do have what I think is kind of a classic reverse head and shoulders, which is a bullish pattern. And if that were to play out, we would ultimately break the neckline, which happens to be the downtrend line, with some force, with some momentum, typically come down and test that as support a time or two. So if this were to play out over the next few weeks, let's say, or months, technically speaking, we're probably going to have to turn bullish on this market, right? That's not what we think is going to happen at this point. Absolutely, though, we could definitely pierce this downtrend line. We have a long ways to go in terms of just capturing old highs and so forth before we can call a new bull market just in terms of levels. But technically speaking, it could become very compelling if certain things were to play out. Beyond the technicals, our position is one that's not necessarily a minority position right here. And that is that the market is anticipating something that the Federal Reserve promises not to deliver. And that is rate cuts during the course of 2023. What the Fed promises to deliver right now is a couple more rate hikes, albeit 25 basis points, and then at a minimum, holding the line throughout 2023. But that comes amid what we view as very recessionary conditions. So what the market seems to be seeing are these recessionary conditions and the belief that the Fed will, as it tends to, come in and rescue the economy. Problem being inflation. And if you look at some of the financial stress indicators, we have our own index, which continues to get softer. We really kind of have easy, financial conditions right now amid rhetoric from the Fed that says they want things very, very tight. We won't get into these weeds, but one thing that's happening under the surface is that the government is depleting its checking account, called the Treasury General Account. And that is essentially money that they've piled up via selling bonds previously. And it was very, very high under the Trump administration. I think we got to like 1.6 trillion under Treasury Secretary Mnuchin. And now it's down, I believe, below 400 billion. So that's actually money that is gone into the economy as net liquidity. There was no new bond issuance here of late, sucking liquidity out of the market to put that in. So that probably has served as a pretty decent offset to the tightening, the quantitative tightening, if you will, that the Fed has been doing. So on a net, we really haven't had demonstrably tighter conditions, despite the fact that we have, a rising Fed funds rate. So again, the promise from the Fed is that they're going to have to remain tight. And I actually believe that the financial markets are not making them feel good right here. I'm not saying they want a crash. I'm not saying they want to see levels 20% below where we are, which is where we think we ultimately go. And we think as we get there, we do think they will panic and pivot, but they don't panic and pivot at these levels. In terms of the technicals, I just kind of pointed out where we are here on the daily chart. We are losing, the downtrend line, which we would expect. It wouldn't surprise me though if we didn't pierce above that for a few days or weeks, but it's not happening right here. In that 200-day moving average, you can see the candle right here. We're doing battle with that. Ultimately, whether it happens this week or next or sometime in March or between now and the end of mid-year, if you will, we believe that this probably gives up the ghost. So looking at the hourly, yesterday I drew this trend line and this dotted trend line here as well. You can see that we gapped down below that quite aggressively this morning. Microsoft earnings were apparently better than what Wall Street expected, but the guidance in the conference call just pretty much killed it from there. NASDAQ taking a good hit today, although the market's coming back here. You can see on the hourly candle off the lows of the day. Here's what we had, and this was yesterday's, just my update of the chart yesterday. Remember I said 40.20 here the other day was going to be stiff resistance. That played out pretty much to a T. We got above that and then gave it up. And we have these just very definite bearish divergences on the hourly chart. So again, like I closed the other day, market can go in either direction. Of course it still can, right? Good earnings from Tesla, this afternoon after the market closes, could be huge in terms of a snapback rally tomorrow. Yesterday, Nick and I, when we were having our morning conversation, we talked about Microsoft and the fact that they just 6 days ago announced thousands of layoffs. Julian Brigden, who is a macro analyst who I have a great deal of respect for, he's been saying for a long time now that CEOs have basically become little more than shepherds of their stock price. So he draws lines that correlate unemployment to the S&P 500 and corporate earnings. The minute earnings begin to wane or the prospects begin to wane, they are going to start cutting jobs like there's no tomorrow. That's what we're seeing, particularly in the tech sector. And we're beginning to see it in other sectors as well. But nothing major, nothing huge, right? We still have very low unemployment, very tight labor market, although keep in mind, generally the labor signals are lagging signals. So that suggests that the worst is yet to come, that the signal from our own index is probably right, that we're probably going to see a recession. We still think it begins in the first half of this year, amid a situation where inflation is probably still relatively high, probably quite a ways from their 2% target. A recession will bring them down to that, but the Fed is probably going to be stubborn a little longer than what the market discounts. Once the market believes the Fed, clearly it doesn't right here, then it probably rolls over really hard. And then it turns out to be right. Then the Fed ultimately pivots. And it's not just the Federal Reserve. I really have my eye on the European Central Bank. I mean, Europe has had a rousing good year so far in terms of their equity markets. And I'm not complaining because we have exposure there. I'm bullish longer term. Most things non-US, frankly. But I think the European market has gotten way over its skis amid really high inflation and a central bank that promises to put out that fire more aggressively rhetorically right now than the US is. So the fact that Europe's holding up, I get it. They had a warmer winter that was great relative to their problems around Russia and Ukraine and getting natural gas. And China reopening is huge for Europe. So the economic sentiment is great. But that does nothing to assuage, in fact, quite the opposite, the European Central Bank's concern about inflation. So I look for the European Central Bank to squash this rally in European equities. And that's going to have ripple effects, obviously, throughout the world. So a lot of correlation right now, short term, among world equity markets. So it's why we're staying hedged. It's why we're actually adding some hedge to things like materials and miners and that sort of thing right here because of what we see are serious recessionary risks. Beyond all this, we think we have probably the best clarity I, speaking personally, have had in my career longer term about where money is going to be spent and how that's going to impact assets and inflation and interest rates over, say, a 5-year time horizon. 5-month time horizon is very precarious right here. Folks, I'll leave it there. Thank you, as always, for watching and listening, and I'll talk to you again toward the end of the week or over the weekend. Take care. Bye-bye.